Typical go way back. I was following a typical path. My dad was a blue collar worker. My mom was a homemaker, and money was always tight, always tight. And my dad kept on telling me, "Go to college so you can get a better job than me. Go to college." And like most people, that's what I did. It's okay. I don't want to have the same job as my dad. I don't want to come home drenched in sweat every day because of what he does. And so that's what I did. I went to University of Utah. I was really good at math and I loved teaching. And so I thought I can be a math professor. Turns out I didn't love math enough for that to really work out, but I did get a master's degree in math. I started a PhD program in math, and about a month into September 11th happened. And the way I tell the story, the dates aren't exactly accurate, but essentially on September 12th, I was at a recruiter's office. And a couple months later, I was active duty with the Marines and really found something that worked for me. Started making more money than I had ever made before. And crazy, nobody goes into the Marine Corps to make money, but that's indicative of where I came from. And
So
I enjoyed
Utah.
it.
Brian Briscoe is a retired Marine and founder and CEO of Streamline Capital, a real estate investment company focused on helping individuals earn high, risk adjusted returns through apartment investing. Since 2018, he's owned over 1,500 apartment units through various partnerships throughout the United States and has successfully exited 9 of those properties to date. He's an apartment investing coach and mentor, the director of multifamily educational community, The Tribe of Titans, and host of his own podcast, The Diary of an Apartment Investor.
He's all in on multifamily and he brings great insights for your own real estate journey. Let's get in the Champions Corner with Brian Briscoe.
Brian Briscoe, welcome to the Cashflow Fight Club podcast. We're excited to have you on and talk multifamily and other things.
Thanks a lot. Appreciate you guys having me.
Yeah, you bet. So, as I teased a little bit, you're currently big into the world of multifamily, or maybe big is not necessarily in the
I'm all
in
in.
the
I think
sense.
that's probably a better term. All in.
Oh,
So
all right. That's what I was curious about.
yeah.
How about a little background first? What
Yeah.
what led you to where you are?
Typical go way back. I was following a typical path. My dad was a blue collar worker. My mom was a homemaker, and money was always tight, always tight. And my dad kept on telling me, "Go to college so you can get a better job than me. Go to college." And like most people, that's what I did. It's okay. I don't want to have the same job as my dad. I don't want to come home with drenched in sweat every day because of what he does. And so that's what I did. I went to University of Utah. I was really good at math and I loved teaching. And so I thought I can be a math professor. Turns out I didn't love math enough for that to really work out, but I did get a master's degree in math. I started a PhD program in math, and about a month into September 11th happened. And the way I tell the story, the dates aren't exactly accurate, but essentially on September 12th, I was at a recruiter's office. And a couple months later, I was active duty with the Marines and really found something that worked for me. Started making more money than I had ever made before. And crazy, nobody goes into the Marine Corps to make money, but that's indicative of where I came from. And
Are
I enjoyed
Utah,
it.
are you a
Yeah.
Utah native? Sorry to interrupt.
I am a Utah native. I was born in Salt Lake County. When I was about 9 years old, my parents moved just north, and so I lived halfway between Salt Lake and Ogden for people who are familiar with it. And my parents still live in that same house. All my siblings are scattered along the Wasatch Front. Yeah, I'm born and raised Salt Lake, and if it wasn't for the Marine Corps, I probably would still be living in Salt Lake. Would have lived in Salt Lake most of my adult life. But as far as how I got into multifamily, I think it's the same thing. It's what you're taught when you're young. It's most of their net worth comes from their house purchase. When I was my first duty station was Okinawa, and then I find out I'm gonna go live in Southern California, and prices on housing was ridiculous. This is like 2006, right before the crash, and I was really trying to figure out how to start gaining that equity. My math brain understood it. It's okay. If I'm going to be paying for housing, I might as well be paying down a loan and gaining equity. And the numbers weren't working out. We moved to San Diego, and it's just I can't. This isn't working. And so I had this bright idea to buy a house in Salt Lake and just rent it out to somebody. I'm like, I can still get the exact same thing as living in a house. And as long as I'm in the military, I knew I was going to be moving every 12 to 36 months. Sometimes you're in one spot for a year, sometimes you're there for 3 years. So bought my first rental property in 2007 and timing was awesome. A month afterwards, the market crashed. And so I literally bought at the peak. But the magical thing about it is I always had a tenant in there. Always had somebody paying rent. My rent covered the mortgage and I could see it working. I could see my brain just latched onto that and said, I need to do this again. And over the years, what I tried to do is every time I moved, I tried to buy a house. And there's some places it didn't work. Like every time we moved to California, the numbers were just inverted. Every time I could buy a place and cash flow. Would buy a house, would live in it for 2 to 3 years, and we turn it into a rental on the back end, and did that 3 times total, including that Salt Lake house, but we did that 3 times, and I could see the cash flow get going increasing over time. I could see the equity increasing over time, and I was hooked, and I started really looking for how to scale that. I pulled out a spreadsheet, and I thought, "Okay, here's how much I'm making right now. How many of these houses would it take me to replace this income?" And the answer was way too many. And so I was really looking at how can I accelerate things? And the answer to me ended up being multifamily. Instead of buying one house, why don't I try to buy a 12 unit apartment or a 20 unit apartment and just accelerate that process? And so got into a coaching program. This is like 2018, 6 years ago. Met a couple of people that was the first partnership I was in, formed a company called Four Oaks. And within the next 2, 3 years, we bought 700 units in South Carolina. Most of them were syndicated. So we were raising money from private investors. And right after I retired from the Marines, I left that company. I was living on the East Coast at the time and we were buying properties in South Carolina. And so I was close. I was close to everything. And when I retired, my wife wanted to move close to family, and so we're just north of Salt Lake right now in a place called Idaho. We're actually across the state line. But so yeah, long story short, I left that company, but I stayed in multifamily. And I've essentially been doing multifamily ever since. But that's basically how I got in, and
Yeah,
I'll let you guys pick and choose where to dive in from there.
sure.
Yeah.
Just a few things that I want to circle back on. So, other than your math brain and desire for some equity in assets, was there something that sparked you in the real estate? So many people we talked to, ourselves included, Rich Dad Poor Dad was instrumental in awakening this concept of real
Yeah.
estate and getting into cash flowing things. Just curious for you if it was something in particular.
I remember reading Rich Dad Poor Dad. I remember exactly where I was. And then I immediately bought Cashflow Quadrant and read that as well. It would have
Mhm.
been 2004. And
Mm.
that did really get me thinking about it. And the funny thing, if you read Rich Dad Poor Dad, he talks about private placements. He talks about syndication. He talks
Mhm.
about multifamily. All right. And I remember reading that, and I don't remember if it was Rich Dad Poor Dad or Cash Flow Quadrant. I remember reading that and thinking, man, he's doing these apartment deals, he's doing these large commercial real estate deals. I'm like, man, that sounds difficult. I don't think I could ever figure out how to do that. And then I had the thought, I'm like, but I could figure out how to buy a house. And so
Yeah.
at the time, I really didn't have the mindset needed to be able to really latch on to everything. But at least I was open enough to say, I don't think I can raise millions of dollars and syndicate an apartment complex, but I could probably figure out how to buy a single family house and put a tenant in there. And so, yeah, that's essentially what I did. And it wasn't for another 10 or 12 years that I really had like that next big mindset change where, multifamily all of a sudden sounded even remotely possible. So yeah, that was a big part of it. I think the other big part of it was just getting for the most part, I enjoyed the military service. The honest truth is I spent a lot of time away from home. On one of my deployments, that's really what kind of spawned the how can I accelerate this real estate thing? And at that point, it was all about getting out. It was all about I've got 16 years of service. By the time I hit my 20-year mark and I'm eligible for retirement, I want to be making X amount of dollars. I want to be able to leave the Marines at my 20-year mark and be full-time into real estate from there. And so that was really the driving factor at that point was this isn't working. I want to be there when my kids have birthdays. And yeah, that was I think the other big issue.
Yeah, that's a similar journey to a lot of people we speak to as well. The question of scaling from single families and this realization for many that, wow, I'm going to have to do hundreds of these
Mhm.
to stack up enough. And that really drives a lot of people into the multifamily space. For those early rental properties that you bought, did you hold those or were you reselling those at some point? Or what's that
Yeah.
philosophy for you?
The goal at the time was to hold forever. I had 0 plans of selling any of them when we first bought them, but as I started looking, I started really paying attention to a metric, return on equity. It wasn't just how much money am I getting per month on these properties. And by the way, I used a VA loan on the first property. I literally put $0 down on my
Awesome.
first property. And so if you're looking at return on investment, my number was ridiculous.
Yeah.
I think I had to pay one fee at closing that the loan would not cover.
Not an infinite return, but
But
something
a
that it was good.
very high. Yeah, I think, I wanna say I paid $3,000 for that first house, a $200,000 purchase, $3,000 total down. And my second one was an FHA loan at 3%. Because we were owner occupants, we didn't have a lot of money in, but so looking at that, the numbers were just ridiculous. But I
Mhm.
started looking at equity. How much equity do I have? And within a couple of years, I had 6 figures of equity in both houses, and I was cash flowing at a couple $100 a month. I'm scratching my head thinking, it's nice getting the cash flow, it's nice seeing the equity go up. My returns crept down into the single digits and started looking at things, and just because of where rates were and rents and everything else, I happened to buy in 2 expensive markets, but the refinance wasn't gonna work. I couldn't do a cash out refinance. I'd already refinanced a couple of times to get a really low interest rate, but a cash out refinance wasn't gonna work on those properties, and really, that's about the same time that I started getting into multifamily, and I started looking at the future, and that really made me think, "Okay, I need to sell these." Release the capital that's in there and use that to start my multifamily career at the time or my multifamily business, and yeah, so originally, it was a buy and hold, and I'm never gonna sell these things, but when I caught a hold of multifamily, I started thinking, "Okay, I've got 100 grand there, 100 grand there, 100 grand there. Man, if I could just release these and start investing in multifamily." But yeah, that's what I did, and I think my returns have been a lot better doing it the way I did.
Yeah, equity is a powerful way to look at things as well, for sure. It is very comforting to have residual monies coming in every month. But when you think about the cost of capital and putting your capital to work and what kind of returns you can get out of something that might be different, I think it does become a more compelling situation. I wanted to weave into that because what I know of you today, just really from social media and seeing what you're doing, is we also have been into multifamily
Mhm,
in the syndication style, but it's very, it's like flipping just at a little different scale, right? So you're always chasing a deal and trying to either just continue that or increase it over time. And it seems like you have adjusted your formula a little bit. And I'm not sure we can talk about the motivations there, but
mhm.
you're more longer term perspective in your properties. I don't know if it's buy and hold forever
Yeah,
or there's whatever, but to touch on that, because I think it is unique and it is something that Lygia and I have also, that's our desire in life is to have something. We don't want to be chasing deals all the time. It's okay now in this phase of our life. We're okay. We're okay to hustle and to
mhm.
chase things some point, we could kick back and let annuities or whatever cash flow
Yeah.
come in. So we don't have to if we don't want to.
Yeah, I do have roughly the same philosophy. I like the long-term holds, but it's a balancing act. I
Mhm.
We did a syndication with a 20-year hold. I think half the people that I talked to that had money to invest were just like 20 years, no, not gonna do it. And so that was the first one, and we're currently raising on one that a 5 to 10-year hold. We'll look at selling after the first we're getting a 5-year loan on it, and we'll look to sell right around the end of that first 5-year term. But if the market conditions are we'll go ahead and just refinance and hopefully a cash out refinance where we can churn
Y-
capital. And I really love the idea of the infinite return model, which and yeah, the math guy in me, it's not really infinite returns, but
Sure.
there is a denominator. I'm sorry, but the idea of that is you get all of your money out and you can reinvest your money somewhere else and you can start stacking these deals and stacking these cash flow streams. I really love that idea, but I think most people who are investing in syndications right now a lot of them, I think, have been conditioned in the last couple of years to want the 3 to
Mhm.
5 year holds, 3 to 5 year holds, and even in a time where a lot of people got burned on these 3-year holds, most of the demand signal among the investors is still 3 to 5 year holds, so
Yeah, I wanna get the money back.
yeah, it is a balancing act. I do like the idea of long-term holds. I do like the idea of just stacking these income streams. And I'm trying to find a model that I think works well with investors. And so that's the balancing act we're trying to play. Something that I really is, like I said, is that long-term hold. But when most investors are saying, I won't do anything over 5 years, you have to meet the investors. Sometimes you have to meet the investors in the middle. Sometimes you just have to completely. But yeah, it is to your earlier point, a lot of what people are doing, these 3 to 5 year holds are exactly what you said. It's like a flip. Just you buy a property, you own it for a couple of years, you turn around and sell it, and you keep on moving on. As long as the market's going the right direction, that's a great idea. But the
But when the
problem
music
is,
stops, it can get ugly.
yeah, and there's a lot of people. I'm LP in a deal that has a foreclosure date next week, and
Mhm.
so that's one of those deals that closed right before the rate hike cycle started on a variable rate loan, and the sponsorship held on as long as they could, and but yeah,
Yeah,
it's
there's a lot of stories out there like that. It's unfortunate.
Brian, before we go into different topics, I'm really curious to find out about your journey,
Mhm.
and how did you find the right partnership for you? Because I know
Oh,
we all
yeah.
know, well, that are familiar with the multifamily investment.
Huh?
It's a team sport. You cannot do it by
Yeah.
yourself, and we know that the good partnerships can either make it or break it. And how was your journey?
The first partnership I was in, I remember getting into the partnership and thinking, "This isn't exactly what I want long term, but this is the best thing for me now." It was a couple of other guys that were in the same coaching program, and we had a lot of things in common, and we all wanted to leave our full-time job. That was one thing. We all had ties to the state of South Carolina. That's another thing, and we all had similar ideas of what we wanted, and so we teamed up and we started syndicating, but that alignment only lasts so long. A couple years later, when we were all out of our full-time jobs because we were making enough money to do it, now all of a sudden, what's the next phase? I wanna go this way, he wants to go that way, and we were pulling in different directions, and so that I ended up leaving that company. So we ended up kinda splitting 2 different directions. 2 of us left and 2 guys stayed with the company. That like I said, that ended up being the best thing for me at the time. I was still active duty, I was still working 10-hour days on average, 10 to 12-hour days on average, and I needed help, I needed support, and with some minor changes, I think the biggest issue is I decided to move across the country for my partners, but that worked well for 3, 4 years, and then left that partnership. I had always wanted to come back home and start buying properties in Salt Lake, and I started thinking about, "Okay, doing this alone is gonna be difficult. I need a partner." And at first, I started looking for partners. When I'm far enough outside of Salt Lake City that it makes for a long day driving there and back. It's about 2.5 hour drive. When I go down to Salt Lake, it's 5 hours on the road. But I started looking for another partner. And I remember I was at a conference with somebody and talking with a guy. I've known him for 3 or 4 years, and he owns thousands and several thousand rental units or apartments. And he's had a couple of companies, successful exits, founded companies, exit, founded company, exit. And now he's very much into real estate. But I remember talking to him about it and saying, man, this is what I really want to do, but I just need to find that partner. And he just looked at me without skipping a beat and said, why don't you just hire somebody? I'm thinking, and immediately I had a million reasons why I shouldn't hire somebody, but after that conversation, I really started thinking about it, and I'm like, "You know what? That's probably the best way forward right now is for me to go hire somebody." With a partnership, and this was right on the heels of that partnership breakup, we had 2 people pulling one direction, 2 people pulling the other direction, and I didn't really I was reluctant to get into another partnership, and so, yeah, about just over about a year and a half ago, I hired somebody to run acquisitions for me. And so my mentality right now is people make the analogy dating and marriage. So you date your partners and then you get married. So yeah, my dating is very expensive. I'm paying salaries, but I've got one guy that I think has long-term potential. He wants to build something. He wants to build the same thing I want to build. And we're both all in. I have hired several people that haven't worked out, a couple people that have been with me 3, 6 months stints. And one or the other of us said, hey, this isn't working, and parted directions. In the last 18 months, I've had 6 different people on payroll. And I found one that I think is going to be long-term partner. And I've told him many times over that the longer he's with me, the more equity we're going to be giving him. So right now, he's getting a salary with bonuses, but we'll open the door and start getting him equity in the projects and equity in the company. And so, yeah, that's my way ahead right now. About a couple of weeks ago, we signed a new contract, put him on a temporary contract to start, signed a new contract with them, and we're both really excited for the future. Yeah, as far as that goes, I'm always looking for talented people. I've learned a lot about the type of people that I don't want on the team, but really, I think what I'm looking for right now is somebody that can just jump in and build. We're in that building phase, newer company. I need people that can jump in and build, and I'm willing to pay a salary for somebody to do that, to test things out. And if things work out, great. And sky's the limit from there.
Yeah, it's a really insightful tip you got there to do that. And
Yeah.
rather than splitting equity and paying someone in that way, you just hire the specific skill set or sets that you need and go from there.
And where I'm at right now, I'm full time. And if I found a partner to split equity with me, it's really hard to find somebody else that has the same amount of time, the same amount of drive, and the same amount of knowledge and experience that I have to split things. So there wouldn't be a 50-50 split typically if I'm finding another partner because they're not going to have all of that. And so when I really started looking at how is this going to work out, when he mentioned that, it took me a couple of months to really settle on it. But just something that kind of worked in the back of my mind. I'm like, I should hire somebody. And I started thinking of all the reasons that I should hire someone. And yeah, I've paid almost a quarter million in salaries over the last 18 months. We've closed 100 units in Salt Lake, total value $24 million. And I own 15% of both those properties. So when you look at it, yeah, it's cost me a quarter million. And that money has come from a lot of these full cycle deals. So
Mhm.
it is scary looking at that number, and I've spent how much on other people, but when I look at the what's in it for me, first property we bought, $10 million purchase price. I just think eventually that property is going to double. That's our 20-year hold. Eventually that property is going to double. And when it does, that's 1.5 million for me because I own 15%. On
Mhm.
the property we closed on last week is in the same situation. It's a $13 million property. Eventually that property is going to double. I think I own 18% of that one. And you look at the numbers, however long it takes that property to double, that's 2 million for me. So yeah, the numbers end up working out. It's just very much a delayed gratification when properties are selling and coming full cycle and other people are buying boats and other things. And I'm helping other people put mortgages on houses and pay their cars, but
You're reinvesting.
I'm
Yes.
reinvesting in a different way. Absolutely.
Let's talk a little bit today. What is your thesis in terms of multifamily? Where are you shopping, sizes, hold periods?
Yeah, shopping, Salt Lake is the answer. I had an epiphany one day. I was in Dallas and a friend of mine invited me to his mastermind. I happened to be in Dallas. I reached out to him. We usually eat lunch when I'm in that area together. And he's like, yeah, let's eat lunch, and sat down to lunch. He's like, what are you doing, tomorrow night? I'm like, nothing yet. But what I noticed from his mastermind meeting is that everybody at that meeting, first of all, were crazy successful, but they all had focused on one thing. And so at the time, I was working on deals in Houston and in Atlanta and Ohio, a couple different spots. And I had my fingers in a bunch of different pots. This was before I hired somebody to work in the Salt Lake market. And that was right about the same time that I got this hire somebody. So I would say between that hire somebody suggestion and this mastermind, that really created what in my mind is my way forward. I'm focusing on one metro. I'm not going to get distracted by what's going on the other side of the Rockies in Denver or Colorado Springs, but there's lots of metros. And if I really want to build something, I need to focus. And the focus is multifamily. I'm not going to stray away from multifamily anytime. And we're picking one metro, which makes it really easy for us. It also makes it really easy for brokers as well, because they know what we're buying. And they know where we're buying. And then as far as property size, that's a function of how much money I think I can raise. We are syndicators. If I could raise 100 million, I'd be buying $300 million projects all day. But I'm not quite at the point where I can raise that amount with the price of multifamily in Salt Lake. We're sitting kind of in that 40 to 80 unit mark right now. Just closed on a 56 unit last week and closing on another 24 units. We were running that syndication as a portfolio, total of 80 units. But yeah, so as we get better at raising money, and maybe as the economy improves and people are a little more willing to invest in multifamily again, our unit counts are going to go up. But where we're at right now is not a bad spot. You can sometimes get better deals on the smaller properties. And if you get in the case that we're running right now, we got two properties, like I said, a 56 and a 24 unit. They're a mile away from each other, same vintage. Quite honestly, you look at the picture of one next to the picture of the other, they look alike too. There's a lot of synergies to having two kind of small to medium sized properties right next to each other. But yeah, as we get better on raising money, we're just going to be getting into slightly larger units. So this one was a $17.5 million purchase between the two properties. The next one is probably going to be in that 10 to $20 million range again until we can raise enough to up our game a little bit.
I love the concept of being totally focused on one market and dominating it in a way as you can. How do you see the 2024 market conditions where you are, and what do you expect, and how do you prepare for what you expect?
It's a really odd time in the market. In most areas in the US, there are record deliveries. And there have been more new multifamily completions this year than any other year in the history of our nation, right? So one thing that we are seeing is a very soft rental market. I was on a property management call this morning, and we're having a hard time renting our studios out because we've had a couple of large brand new properties that are 100% studios, micro units. I hate micro units. They're like 300 square feet units, but there have been three large projects with micro units dumped into the market. We're seeing a soft rental market. When we're getting people to renew, we are getting like a slight increase in rent bump, but when people are moving out, we're usually a slight negative trade out. We're usually dropping $25 to $50 on our leases. As far as, rental prices, because of all of those deliveries, not only do we have the rising interest rate effects that have dropped prices, we've also seen rents decrease as well. But looking at both, I think both trends are very temporary. Starting next year, we're going back to pre-COVID levels on the new deliveries, and so we're not going to be competing with all the new product anymore. We're going to go back to more household formations, and that's what you need when you're looking at deliveries. You have to match it up with household formations. And Utah's projected to have more household formations than deliveries for the next 3 to 4 years. So right now we have a soft rental market that should slowly change, and sometime probably mid to late next year, we're going to see Salt Lake back to what Salt Lake has been, and that's 97% market occupancy. As far as pricing, I think everybody's waiting for the Fed to start cutting rates. Everybody's predicting that to happen before the end of the year. And I think whether it's the end of the year or next year, it doesn't matter too much as long as we're looking at this long term. If I'm trying to buy something today and sell it in 6 months, yeah, that federal funds rate does matter, and the 10-year treasury matters. But if you look at what's going to happen over time, if rates come down, prices are going to rebound pretty quickly. But if rates don't come down, I think the market still has a little bit more adjusting to do, but it'll still end up going back up. And yeah, as far as market, it is a very tough time right now for lots of reasons, but it's also it's also the time where a lot of people can make a lot of money by getting into the right properties with the right basis price and be able to move on. We're buying things at a 25% discount to what it was a couple of years ago. And if we can get in and cash flow for a couple of years, give some decent returns, and when the market does start coming back up, when rent prices start coming back up, when values start coming back up, we're going to be in a really good position. And the extra work it's taken us to get these deals under contract and to get the capital raised and to get loans. Loans are a little bit, the debt market's a little crazy right now too. But long story short, I think it's a great time to buy right now because it is so difficult. As opposed to 3 years ago where everything was easy, money was easy. I think right now we're going to be seeing really good returns on our properties in the next 3 to 5 years.
Yeah, I totally agree. Things have flipped a bit where really back 2 or 3 years ago, when you think about it, there was only one direction things could go because money was free almost.
Yep.
And now it's a different ballgame where the movement is likely in a better direction for a residential type or housing market, let's say, other than overall price. One thing I am curious about, do you have an acquisition strategy? Are you looking at particular classes of properties and or value add, or are you open just to whatever the market yields at the time? Or
Yeah, ideally, it's a value add. So Warren Buffett in the last Berkshire meeting put out a tribute to Charlie Munger, and he said something. Advice Charlie gave Warren was buy fantastic businesses at fair
Mhm.
prices. And that's exactly what I'm trying to do with properties as well, is buy fantastic properties at fair prices. And so what does that mean to me? I want the properties to have a strong rental history. You look at the rental history of if they've been full for 3, 4, 5 years straight, they're probably going to be full for the next 3 to 5 years. So we're looking for strong rental histories. We're looking for areas that we think are going to be better 5 to 10 years from now than they are now. So we're avoiding the areas that are in decline or looks like they soon will be in decline. One thing I like looking at is flippers. Most apartments are pretty close to single family communities, but some of these neighborhoods where there's a lot of flipping activity, that's a sign that things are on the up and up. In Salt Lake, where we're seeing bulldozers and wrecking balls in a lot of areas, where we're
Mm.
seeing a lot of parking lots turned into retail or something else. And so we're looking for the areas most people refer to as path of progress. And as far as asset class, I want to end up at a B class. I've done a whole lot of C class properties in the last 6 or 7 years. I think we've owned two B class property, three B class properties. Out of the 1,500 units that I've owned, three of them were B class properties. But I do want to, I won't rule out purchasing a C class, but I want to be able to put enough money and have it in an area where I can turn it into a legitimate B class. That's what we're looking for, is just properties that are going to be performing for strong performers for the next 3, 5, 10 years. And they don't have to be the sexy ones. Sometimes these are the properties that so you look at and you're like, yeah, that's an apartment complex. But yeah, we wanna end up at a B class. A lot of times we're buying 70s, 80s, and haven't bought anything 90s vintage yet, but that's like where we're usually finding that stuff right now. Something that right now is a C plus and needs a little bit of a facelift, has room for amenities, is like the perfect thing for us.
Nice. Yeah, especially if you're holding for 5 to 10 years, you have to think down at resale, it's gonna have some definite age and wear and tear on it.
And, the deals I've done so far, we've done 3 to 5 year holds, and we've done full renovations, and we're handing properties over to people that are fairly stabilized.
Mhm.
I do realize that with a 10-year hold, we're gonna be selling somebody a value add property 10 years from now. The economics just don't really make sense for us to do another renovation 10 years later unless we do a really good if we have a cash refinance and a really good cash out period, we could. But when you start looking at the hold periods, all that other stuff matters too. You're going to have to keep things maintained. If you're holding something for 10 years, that's about where you'd want to do a full renovation anyway. So yeah, buy
Which can be
something. Yeah,
attractive to incoming buyers as
it
well, right?
is. And the crazy thing is, it depends on the market you're in. But 2020, like 19 to 22, you almost got a better price on the value adds than you did on the stabilized properties because people
Mhm.
were looking at, hey, there's meat on the bone. There's more for us to make here. It's not true in every market. I think, yeah, buying a property, fixing it up now, owning it for 10 years, and when it's time to get that next renovation in, that's a good time to stop and sell it.
Let's shift gears just a little bit. You are at this point giving back and sharing a little bit of your expertise. Why don't you tell us what you've got going on that front?
Yeah, so a couple of years ago, when I started doing this, 6, 7 years ago, I always how can I put this? It seems like I enjoyed talking with wannabe syndicators more than I enjoyed talking with potential investors. And this whole time, every syndication I've done, I brought in a couple of new people. Hey, giving people their first chance, and a lot of people will still look at me and say, "Hey, Brian gave me my first chance on a syndication. Brian, and it's something I've always enjoyed doing. And at one point, I realized that a lot of the people that I was helping was just like a flash in the pan. It wasn't. It was one phone call here, and maybe six months later we'd reconnect or something like that. But I started realizing that for me to really have impact on other people, I had to have something formal. I was against the high ticket coaching program. I've done a couple of programs like that, but I didn't want to have a program like that. But I started realizing a couple of things is for me to really have an impact on somebody, it had to be more than just a transitory thing. There had to be persistence. And the other thing is the person on the other side had to be as committed as I was. And so I think the natural where I ended up and where I realized I needed to end up is I had to have a program. I had to have a system. I had to have all of that stuff. And I also had to charge money, which is not a bad thing for me at all. It's not terrible. But so yeah, about a year and a half ago, it took me probably 2 years to write content, assemble content, and put everything together. But yeah, about a year and a half ago, I started bringing in individual coaching clients. And any given time, I'm somewhere between 5 and 15 individual clients. We do 2 1 hour kind of group sessions per week. And then they've got me one on one for a couple times a month if they need it. And yeah, it's fun for me. I'm able to help a lot more people and not just give them a hand occasionally, but really help people go from where they're at right now to where they want to get to.
Yeah. Who are the people that are coming through your program, which I think is Tribe of Titans
Tribe of
is what
Titans,
oh,
yeah. Funny, most people look like I did 7 years ago. They're
funny how that works out.
yeah, I think I saw this recently on a meme, and it's you're best able to help out your previous self. When people who are in a job and for one reason or another want to get out of it. And I think for it to work out, you have to have some sort of success skills. You can't just so I am looking for people that have had some success in their career, and that tends to make it easier for them to do it. But someone who's willing to dedicate the time, somebody who's, willing to put in the effort. And I think with where I'm at and where I've been, it works best for the people that are in that mid-career phase and just looking to build something on the side and eventually make that something their full-time gig.
Yeah, nice. Yeah, we find that as well. We do a little coaching in a different avenue, but definitely there are people that you can tell are go-getters and are hungry and are going to do what it takes to go through the course and to be successful. And there's others that are not as committed, let's say, and
Yeah.
it's okay too. But
Yeah,
uh,
and you never know how committed somebody is until it's just like
yeah,
finding partners. It's the same thing with coaching clients. I've had a couple of guys completely surprise me both directions. People I thought would do great that have never showed up.
mhm.
People that I thought were, yeah, I guess I'll take your money that have done amazingly well. It's a little, you get a little bit of both.
It's the same. We buy and sell a lot of vacant land in our primary business, and yeah, we learned early on not to prejudge clients. Right,
Yeah.
they're like, "Oh, this guy's never going to buy this property," and they're down the cash, or
Mhm.
other people are ghosting you or something. So yeah, very true with the clients as well.
Yep.
Your coaching clients.
Yeah.
It triggers a thought that Tony Robbins has this quote that I love, that success without fulfillment is failure. It seems like you have the right formula,
Mhm.
because giving back really is brings up that fulfillment that you cannot get
Mhm.
somewhere else,
Mm.
and helping other people do what you do. And also, I'm sure you grow. Mike and I, when we do coaching and we help other people, there's so much growth
Mhm.
happening because we grow with them. They ask questions that we never thought they're gonna ask, or we just didn't think about it, and we have to find answers.
Yeah.
And it's happening. It's so much growth, and
It's nice when and this may sound counterintuitive, but it's really nice when somebody stumps you as a coach because you don't have an answer. You're just like, I'm gonna have to really think about that one.
I'm going to learn
yeah.
something
Yeah.
here. Yeah.
So, but yeah, I think learning while coaching is something that has happened to me frequently where somebody will say something and a lot of times the coaching sessions, the way I have it set up is I have a lot of online content and I want the coaching sessions where we're live to be giving them exactly what they need at the time. And so I always start out with, hey, who has questions? What questions? Where are you guys stuck right now? But a lot of people in the group want to hear about my deals, exactly what I'm doing right now. And so we typically spend about half the time talking about what their questions are and half the time talking about what my struggles are. Cause Here's the deal. I've been in this 6, 7 years now. There's still things that are difficult. There's still wrenches thrown in the system. There's still things that don't go right. But every once in a while, someone will ask a question. Why don't you do it like this? Well, that's actually a really good idea. Yeah, I think it does help everybody there just discussing things. And it's the same thing when some of the clients come with questions is other coaching students will pitch in, "Hey, what about this? Have you thought about this?" And it really does help everybody else out.
The power of the group is undeniable. We share a lot of the same things as well. Like we'll have clients that are thinking in different directions or finding new tools or systems or running faster than we are. And it's a great learning environment. It's a great motivator and inspiration initiative. So
Yeah.
that's great. What I think I'm getting a feel for it, but it sounds like your program people come in and it doesn't depend, it doesn't matter what market they want to be in or things like that. Are you helping them understand the nuances of certain markets in terms of
Yeah.
market research and good deals or not, underwriting, things like that? Or
Yeah, we do. I looking at the syndication journey, it is designed mainly for syndicators. I mean, I do have one or two that are not really on the syndication route, but they wanted to learn more about multifamily in general. But when you look at the syndication route, I think there's people who are really good at raising money and there's people who are really good at finding and managing the deals. And I have two separate tracks. It's if you want to raise money for other people, here's where we focus. These are the things you need to be doing. And for them, market analysis is important. I don't think it's quite as important for the
right,
people who are actually in that. They have to know enough about the market to understand, is this a good market? Is this a good deal for whatever they're raising on? But I think it's a different level. So yeah, we do teach people to analyze markets, to look at the macroeconomics, look at what's going on at a local level. And the same thing that we talked about earlier. I typically want to look for the areas where neighborhoods are going to be better 5 to 10 years from now, or at least stable for the next 5 to 10 years. And yeah, we teach people, it doesn't matter where they're at. I have a tendency to believe that try investing in your backyard first. And if for some reason it doesn't work investing in your backyard, then you start looking at other metros because there's a lot of things that become a lot simpler when you're investing close to home or if you're investing in the city that you grew up in. There's a lot of things about that metro that you're going to intuitively know. You're going to intuitively know, okay, this is a good area, this is a bad area. I've spent almost 30 years in Salt Lake, and you give me an address, and first of all, Salt Lake's the address is based on the grid system. So you give me an address, I know exactly where it is. But I can also tell you, okay, that might be a little sketchy area. I get people calling me, very frequently, and hey, what's this area like? What's that area like? But yeah, we talk about where to start investing first. And when we talk about underwriting, I like to focus more not on how to put numbers on spreadsheets. Yeah, that's just practice. You get a spreadsheet, you do it a couple of times, but more on like the underlying meaning of the numbers. And there's lots of levers involved. What happens when you pull this lever? What happens when you pull that lever? If you've got a deal that is borderline, how can you pull a lever here and do a little bit of nipping and tucking there to make the numbers work? And we're not stretching, but just like changing deal structures. Maybe you get
like
a
a strategy or a
yeah,
different tactic that can
exactly.
change.
Yeah. Slightly
It
different model.
reminds me of a story. We were also in a multifamily group,
Mhm.
and some other people that were in the group were talking about different sponsors to invest with or to partner with. And someone made the comment like it was somebody else that was a degreed math professor, and they were like, "She's good at math. We're going to partner with her." And
Mhm.
I'm like, Math, really? Okay." The spreadsheets do a lot of the math for you.
Mhm. Yeah.
It can also be a negative in a way
Mhm.
because you can't know how to manipulate the numbers and to make a deal work. It's more important the underlying
Yeah.
variables underneath all the variables,
Mhm.
right? You have to understand, is this from a business sense, is this going to work? Are we stretching the renovation budget too tight? Are they reasonable? Is the
Mhm.
rent growth or are the expenses? All those kind of things, right? That comes down more to business and common sense and understanding the meaning behind the number
Yeah.
rather than just understanding how to make formulas work and things like that,
Yeah.
which is important. But there's a lot of macros and spreadsheets that really bake that in and do it for you. So
Yeah, the highest level math I think I've done recently, yeah, I do have 2 degrees in math and I'm really good at it. I'm doing arithmetic most of the time.
yeah,
I haven't done an integral in 25 years, but when you're looking at my daughter was in calculus, I did help her, so maybe 8 years. But yeah, one thing I think I err on the side of caution. I'm a little more conservative on certain things 'cause I know in math, we talk about variables that are sensitive. What does that mean? Small changes in input make big changes in output, okay? And that's a sensitive variable. And I know what variables on the spreadsheet are really sensitive. If you change your exit cap a little bit, guess what? You're going to get a really big change in your output. So I tend to be a little bit more conservative with the sensitive variables. And my underwriting tends to be people look at it and are like, that's not a good deal. I'm like, but look at this. So yeah, it could go both ways. You could be looking at that sensitive variable and say, I'm just gonna turn it up a tiny bit. When you turn it up a tiny bit, the numbers look great. And you're like, can you hit those numbers though?
especially if you're stacking them and you
Yeah.
really,
So yeah, knowing all of that does give you a lot of yeah, you can do good or bad, just like anything else. You can take what you know and do good with it or do bad. But I tend to be a little bit more conservative, tend to
things
take
go
those.
wrong, right? I mean,
Yeah.
it's not, especially with, I don't know, let's say 50 different variables in an underwriting, something is going to happen. Hopefully there's some canceling out of things that happen favorably and unfavorably, but yeah, it's inevitable that you can't dial them all
Yeah.
into the red zone and expect your deal to perform. Talked about that at the beginning of the show, right? A lot of people feeling that pain
Yeah.
today of the
Yes.
unexpected happening
Mhm.
and having a solid business case.
Yeah. And speaking of, I actually bought a rate cap yesterday. It's something rate cap insurance is you buy it so that you have protection if rates go up. But
You know, hopefully you don't need it.
Yes.
yeah,
Yeah.
hopefully we don't need it. But we did get a variable rate loan on this project that we just did. It is a value add, and we did get a bridge loan. And people right now are just like, oh my gosh, bridge loan. It's just, yeah, it's a completely different market today than it was two
Right.
years ago.
The probabilities are totally different than, like I said,
Yeah.
when money was free and rates were 0 or really low, there was only one way they could go, and
Yeah,
so
and I think we're on the opposite where numbers are going down and the interest rates are going to be going down over time. But speaking of the conservative nature of things and making sure that we're going to be able to hit our numbers, I bought a rate cap. And
yeah.
it turned out that buying a rate cap lower than current interest rates was not that expensive. And so I
Oh,
did. I
wow.
got an email earlier today saying that I'm getting my first check of $4,000 from the rate cap company for a rate cap
Yeah.
cost me 34,000. And so it's
Right.
yeah. So yeah, there's things that you look at. My math brain and having gone over spreadsheets a lot, I think what that does for me more than anything else is I intuitively know a good deal when I see it. When I start looking at numbers and when I start seeing things, it's sometimes I can't put my finger on it, but I intuitively know a good deal. It's, you know what? This is it. This is it. This is going to be a good one. Hopefully time proves that my intuition is right. So far we've done okay, but
That's great.
That's awesome. Brian, the time is no way. I would love to talk to you way more, but we like to end each episode with gratitude. Do you have anybody that you can think of? It doesn't have to be one person that you want to shout out to that has been instrumental to where you are today.
yeah, recently, I'd say Steven Richards. He's the long ball hitter that I was talking about earlier. That's
Mm.
going to do. We're going to do great things together. He's a workhorse, and the last deal, I think he did 90% of the work, and I just pointed in the right direction in a lot of places. But yeah, him most recently, and then of course, family is always important. They're what drives me. It's the kids saying, "Dad, are we going to go on a vacation this year?" It's okay. I'll close another property or acquisition fee, and we'll do a nice vacation. But yeah, the kids. That's why I started doing this, and I've got to always remind myself that's why I started doing this.
Yeah, important to have a why and a strong mission to help push us forward. Certainly are grateful for you coming on and sharing your wisdom with us. For anybody that is interested to get in touch with you and or hear a little bit more, what's the best way or ways for them to reach out?
LinkedIn is the best way to reach out. I'm on LinkedIn several times a day. Send me a connection request if we're not connected. Send me a message if we are. And I'm better at answering LinkedIn than I am emails, phones, or texts. That's probably the best place to reach out to me.
Okay, we'll get a link in the show notes so anybody that is interested can do that or they can just find you. But yeah, thanks again for coming on the show. We wish you nothing but the best and
Yes.
hopefully smooth waters and good times ahead for all of us in the real estate business.
Thank you. Appreciate it.
All right, take care, Brian. For those of you joining us today, we hope you enjoyed this time in the Champions Corner as much as we did. Got some awesome takeaways, and most importantly, will take action to continue living your best life and maximizing your potential. Mindset is such an important aspect of life, and when coupled with action, delivers undeniably powerful results.
Please subscribe to the podcast to hear from more great guests and get the latest mindset mastery insights and cash flow matchups.
Again, thank you so much for investing your time with us, and we look forward to seeing you next time on the Cashflow Fight Club podcast.